Hi, my name is Soumya Roopesh and I am here to do the presentation on accounting theory. What is meant by theory? Theory is a coherent set of hypothetical, conceptual and pragmatic principles forming the frame of reference for the field of inquiry. This was the definition provided by the accounting researcher Mr. Hendrickson in 1970. This can be easily understood as follows. It is an idea, opinion or speculation. It can also be expressed as an hypothesis which is then tested. For example, the managers whose pay is based on the accounting profit will use the accounting policies that maximize profit. In short, it is the predictions based on the logical reasoning. There are different types of theories. Some of them are listed below. The first one is the positive accounting theory. The second one is normative accounting theory. The third one is system-oriented theories, and the fourth one is accounting regulations. Some of these theories do have the sub-theories as well. What is normative accounting theory? The normative accounting theory is defined as follows. The accounting theories that seek to guide individuals in selecting the most appropriate accounting policies for the given set of circumstances. The main purpose of this theory is to guide the individuals responsible for preparing general purpose financial report. The New Zealand framework is the perfect example of the normative accounting theory. Who prepares the New Zealand framework? There are two bodies mainly who prepares the New Zealand framework. The first one is the New Zealand Accounting Standards Board or the External Reporting Board, and the second one is New Zealand Institute of Chartered Accountants, which we are all known as NZICA. New Zealand framework seeks to identify the objective of general purpose financial statements and the qualitative characteristics that financial information should possess. According to the New Zealand framework paragraph AOB2, to provide financial information about reporting entity that is useful to existing and potential investors, lenders and other creditors in making decision about providing resources to entity. The objective serves as a foundation for the various releases that form the output of New Zealand framework. If there were any disagreement with this central objective, and there are many disagreements in the academic sector as well, it's unlikely that agreement with the subsequent prescriptions provided within the framework should be obtained. As I said before, there are different subsections for the several theories, and the subsections of the normative accounting theory are as follows. Conceptual frameworks, current cost accounting, exit price theory and appraisal value accounting. I am further going to explain what is conceptual framework normative accounting theory. Conceptual framework also seeks to provide recognition and measurement rules within a single coherent and consistent framework. The conceptual framework is defined according to the US Financial Accounting Standards Board as follows. A coherent system of interrelated objectives and fundamentals that is expected to lead to consistent standards. It prescribes the nature, function and the limits of financial accounting and reporting. The use of term prescribes supports the view that the conceptual framework is a normative theory of accounting. This is one of the diagram of conceptual framework. Without the conceptual framework for the financial reporting standard would have been developed in a fairly ad hoc manner, which would create problems in preparation of the financial report. Hence, the conceptual framework was initiated as the means of reducing such inconsistencies. According to the New Zealand framework paragraph NZB 4.1, the purpose of the New Zealand framework is to assist the FRSB, that is Financial Reporting Standard Board, in preparing the accounting standards and also reviewing the existing IFRS standards, also assisting the FRSB in developing the New Zealand equivalent to IFRSB, And all in the absence of New Zealand equivalent to an IFRS to assist the FRSB in developing the financial reporting standards. The New Zealand framework identifies the qualitative characteristics that financial information should possess. The two main qualitative characteristics were identified as and they are relevance and faithful representation. The financial reports represent economic phenomena in which and in words and numbers. To be useful, financial information must not only represent relevant phenomena, but it also faithfully represent the phenomena that it purports to represent. To be a perfectly faithful representation, a depiction would have three characteristics. It would be complete, neutral, and free from error. Of course, perfection is seldom, if ever, achievable. The board's objective is to maximize those qualities to an extent possible. This was the definition provided for the faithful representation in the New Zealand framework, paragraph AQC 12. Conceptual framework do not purport to codify existing practices and as such are not descriptive of practice. Rather, as perspective framework that is intended to be logically developed, they makes many recommendations which represent the departures from the currently accepted practice. For example, financial reports which were traditionally prepared by adopting the concepts of prudence and conservatism, which requires the asset should never be overstated, liability should never be understated, and revenue recognition should often be deferred until the time as the related cash flows are realized. This is the concept of prudence acts to the produce financial statement that are biased towards understanding the net assets of an entity. The notion of prudence is, however, inconsistent with the New Zealand framework, which requires a neutral depiction without bias in selection or presentation of financial information. That's all about the conceptual framework. Thank you for listening.